You've probably heard people talk about the S&P 500. It's mentioned in news, investing videos, and financial advice. But many beginners don't actually know what it is. Some think it's a stock, others think it's a company. In reality, the S&P 500 is something very different and very important in the investing world. In this video, we'll explain what the S&P 500 really is, how it works, and why it matters for long-term investors. What the S&P 500 is. The S&P 500 is a list of 500 large companies. These companies come from different industries like technology, healthcare, finance, and retail. Together, they represent a big part of the overall market. Instead of looking at just one company, the S&P 500 shows how a large group of major companies is performing. That's why it's called a market index. Why 500 companies? You might wonder why 500 companies. The goal is to capture a broad picture of the economy. If only one company were included, it wouldn't represent the market well. By tracking 500 major businesses, the index gives a more balanced view of overall market performance. Different sectors help reduce the impact of one company's poor performance. How it works. The S&P 500 goes up or down based on how these companies perform. When many companies in the group grow, the index rises. When many struggle, the index can fall. This movement reflects the general direction of large companies in the economy. It's not about daily drama, it's about overall trends. Why investors watch it. The S&P 500 is often used as a benchmark. A benchmark is a way to measure performance. Investors compare their investments to the S&P 500 to see how well they are doing. If the market grows over time, the index shows that growth. That's why it's widely followed. Long-term perspective. In the short term, the S&P 500 moves up and down, but over long periods, it's generally trended upward. This reflects the long-term growth of businesses and the economy. That's why many long-term investors focus on years, not days. Diversification benefit. Because the index includes many companies, it provides diversification. Diversification helps spread risk. If one company struggles, others can balance the impact. This makes the S&P 500 less dependent on a single business. Misunderstandings. Some people think the S&P 500 is a stock you can buy directly. It's actually an index, a measure. Investments like index funds and ETFs are created to follow it. Another misunderstanding is expecting quick profits. The S&P 500 is mainly used for long-term growth. Why it matters. Understanding the S&P 500 helps you understand the market. It gives a simple way to see how large companies are doing. It also shows why long-term investing focuses on growth and diversification. It's a foundation for many beginner investing strategies. Conclusion. The S&P 500 is not just a number. It represents hundreds of companies working, growing, and shaping the economy. For beginners, learning what it is an important step in understanding investing. Disclaimer. This content is for educational purposes only and should not be considered financial advice. Please do your own research before making any financial decisions.